Hey, welcome to Everything Money. We're glad you joined us again. We are talking today about 3M, an incredible company we'll get into. We will use our 8 pillars to look at the financials and the numbers of the company and separate it from the stock price. We will show you what you should be paying for this company. If you'd like to trade 3M at a quicker pace with Trader Mo and the Business Nation, we will show you the charts to trade with this. But first, who are we? Paul, I bring your questions to people at home. I bring your questions to a couple wealthy guys who manage over $100 million in real estate, businesses, and stocks, and they will walk us through their mindset and process of investing in a company like 3M. I introduce you to Paul Gabriel.
Thank you very much, Seth. So this is our exclusive Everything Money software, which you will find out about the end. We click on the 8 pillars. I type in 3M.
This is a 100-year-old company, folks.
Is it really?
Yeah, they have 4 business segments: safety and industry, transportation, electronics, healthcare, and consumer. 50% of their revenue comes from outside the Americas, and I find all this information on our software as well, Paul.
That's
but
right.
Keep going.
60,000 plus products.
Wow.
All right. So it's a $105 billion company market cap. First pillar. We want the 5-year PE less than 22.5. This is taking the current market cap dividing by the average earnings of the last 5 years, and it is 20.4. That's a check mark. We then look at the 5-year return on invested capital.
Yeah, we want this above 9, Paul.
We want above 9%. It's 14.4, another check mark. So this is a company that does a very good job of investing the capital within the business. This is a very important aspect, something that a lot of investors like Warren Buffett and Charlie Munger really love. A lot of value investors love this. Now, Sethi, we got a dividend over here.
Oh, look at that, twice the market.
Oh, more than twice the market. It's 3.2%. The market's like 1.3% or 1.2%.
But can they afford the dividend, Paul?
So this is very important. Most people just assume the dividend is taken care of. It is not. You have to take the dividend paid on our software here, $3.4 billion, and to make it easy for you, we put it right above, a few lines above. Their 5-year average free cash flow is $5.6 billion, and their last year's free cash flow is $7 billion. So $3.4 billion was easily covered last year and in the previous 5 years. So it looks to me like the dividend is safe, okay? Mm-hmm. So pillar number 3, we go to the income statement on our software.
We want revenue growth over the past 5 years for pillar number 3.
So we put up the last 10 years for you, 30.5 to 34.73, check mark. Hey. Not a lot of growth. Revenue is only up 10 or 12% over the last 5 years, but this is a large company. Yep. That's to be expected. Don't get turned off by that. You should look at it as a good thing. Why? Because everybody else probably looks at it and says, what a boring company. I look at it and say, great. They think it's boring. The stock price could very well be down. Pillar number 4, we slide down a little bit our software.
Profit growth.
We go to the net income line. Profit of 5.39 to 5.95. Check mark there. Barely up, but very consistent over the last 10 years. Look at these consistent numbers, Sethi.
Yep, a little bit of growth, nice and slow, like a turtle.
Slow and steady. Now, pillar number 5 is one of the most important ones, and it's often overlooked by every investor out there who's not a value investor. Share dilution. What we want to do is, do they have more shares outstanding today than they did 5 years ago? Why is that important, Uncle Sam?
Well, also often, it's funny, Paul, I watch some of these videos, and without talking about share dilution, they talk about where this company's going in the future, what a massive uptick it's going to have in the future. But share dilution can hurt you right now. As a shareholder, they're thinning out the pieces of the pie that you own of this company.
Yep. So I call it a silent killer of investments. Why? What the company can do is, if you own 100 shares and they issue tons more shares, you still own 100, but now it's divided by way more shareholders. So let's say the company has 1,000 shares out there, you have 100 of them, you own 10% of the business. If they go to 1,500 shares, you still own 100 shares of 1,500 now, which is 6.6% of the business versus 10%. You've been diluted. You've been killed essentially without even knowing it. Now, their shares outstanding. 5 years ago it was 598. Now it's 581. Check mark there. So that's good. They're buying back shares, okay?
Pillar number 6 is total long-term liabilities divided by 5-year free cash flow. We want this multiple under 5. Can they pay off their debts, Paul?
So it's important to look at companies and look at their debt levels. Obviously, a company with less debt is more likely to survive than a company with more debt. Just like you personally, your neighbor and you have the exact same income, lifestyle, house, but they have $1 million in debt, you have 0. Who's more likely to survive? Okay, so we go back to our Trusty Software's main page. We go to the 5-year average free cash flow, $5.6 billion. I multiply it by 5. That equals $33 billion. So I want their long-term liabilities to be under $33 billion. So I go to the trusty balance sheet on our software. I scroll all the way to the bottom, $24.3 billion. That's a check mark. because we're okay with 33. It's under 24. That means in under 4 years, they will be able to pay off all their debt, long-term liabilities, if they took all their cash flow to pay down debt. Okay? At least it's a cash flow. Now, the cash flow statement here, this is the most important aspect to me. I look at cash flow more than earnings. The reason I do that is because cash flow is harder to manipulate. Earnings are manipulated by SEC rules, accounting rules, things the company can do. Cash flow is just cash in, cash out. Free cash flow is cash from operations less your capital expenditures. Now, what I do here is for our subscribers to our software, they have this line put right underneath here. Other software has it elsewhere in the software. We have it right here. And it tells you exactly the numbers. So 5 years ago was 5.38 billion. Last year was 7.08. That's a check mark. Okay. Now, the final metric, the final pillar, we take our average 5-year free cash flow. We multiply by 20. Most common question is, why did you multiply by 20? Well,
that's how our viewers sound.
It's not how they sound. Typically, in a 1-year basis, you want to pay less than 15 times free cash flow for a company. Mm-hmm. However, we're looking at 5-year average. So if it's increasing, we're willing to pay a higher multiple of free cash flow than if it was just 1 year, one off the chart year. So 5.58 billion times 20 is $112 billion. Roughly, 111 point whatever, which is a check mark because the company is currently $105 billion.
That's correct, Paul. Yeah.
So, does this mean you should buy the company? Not necessarily. A fast-growing company versus a slow-growing company, you need to be able to pay more for a fast-growing company. So that's why, first off, let's look at the 8 Pillars tab. Oh, this is all 8-pillar talk.
Oh.
I didn't realize that.
Check, please.
Guys, our 8-pillar tab just does all the work for you right here. 8-pillar stock. Now, some of you out there might say, does that mean I buy it? Pump the brakes. If it was only that easy, we would do that. But what we did was we created a stock analyzer tool exclusive to our software.
Why have you not brought up the stock price, Paul?
Stock price can be manipulated by so many things, by number of shares. That's it. Look at Berkshire Hathaway. Their stock price is $450,000. Mm-hmm. Does that mean they're more expensive than Amazon because Amazon's at $3,000? No, actually, Amazon's more expensive than Berkshire Hathaway. For those of you who don't understand that, go watch more videos because it's about how many shares outstanding there are. It's about the company itself and the total revenue, total profit, etc. So that's why I haven't brought it up yet. So I go to the stock analyzer tool. I pick number of years of analysis. I pick 7. Actually, for a company like 3M, it's been around a long time. It's probably been around for a long time. I'll pick 10 years of analysis because I'm very long-term oriented. I'm going to pick 2 assumptions, so it's going to go low and high. Now, here's what the software does. It gives you the 1, 5, and 10-year numbers, asks you to make assumptions. Makes it very easy for you. So first one, revenue growth. Even though they had a big jump last year, over time, they don't tend to do well, so I'm going to go 1% and 3%, low and high. Share change. They tend to buy back shares, so I'm going to say minus 1% and minus 2%. Profit margin, pretty consistent, 15 and 17. Free cash flow margin, 16 and 18. PE. Now guys, PE and free cash flow multiple. The bigger the company, the slower the growth, the less the PE you should pay. This is a very, very large company. I'm going to go 13 and 15 for both of these because it's a boring company. Mm-hmm. Now, for my desired return, I always put in 12.5%. Why do I put in 12.5%? Because the market's going to do 10% if I just buy an ETF over long periods of time. So for me to go pick individual stocks, I want a reason to. So I want to get a higher return.
What we're trying to show you at home is just a 1 or 2% difference in your total portfolio over the next 40 years can be drastically change the amount of money you have when you retire. Millions of dollars of difference, right, Paul?
Absolutely. So I put all this information in, I hit analyze, and guys, guess what? It's overpriced.
Still.
So here's an 8-pillar stock that's overpriced. Why? Because the growth isn't there. Mm-hmm. Now, some people will say to me, well, Paul, the dividend, you can't add the dividend to this return because I'd be double counting free cash flow. It's a little bit more complicated to explain it, but I'm doing a present value of all free cash flow. So if I add the dividend on top of it, I'm double counting the cash flow coming in and a dividend out. So I'm looking at this saying, where do I feel the stock is? It's probably 130 or so if I were to throw a gut reaction to it. Seth, when was the last time the stock was 130?
You know, it's funny. 3 years ago, it was $250, Paul. So
wow.
130 was like, COVID crash. It got down to 130, 124.
Okay, 117, COVID crash. But look at this saying, guys, This is a company I am definitely going to be watching for a long time. And as the stock falls or the fundamentals get better, I'm going to keep watching it and try to buy shares.
This is a prime example of maybe disregarding what your friends are talking about, the Bitcoins and Teslas of the world, and looking at companies that have shown strong financials for a decade and then finding them at a very low price. And you can do all of this in the app, our Everything Money app. Paul will show you how to get it right now and what it does.
So guys, the software was created because our users said, how do I do analysis without waiting for your videos to come out? Perfect idea, so we created the software. What do you get with it? You get all of this on a desktop or a mobile app. All of this is also on your phone. You get a community of over 6,000 people you can chat with every single day, 24 hours a day, all across the world about all your investment ideas. You get exclusive daily content from Mo, Seth, and I. 2 videos a day where we just talk about other random things that's only exclusive to our software subscribers. You get real estate calculator and other software we're going to add to it. We are not done with the software. We are adding so much more to the software as time goes on. You get news, you get everything you've seen. It's a no-brainer, and it's only 90 cents per day. If you are serious about your financial future, 90 cents per day could literally lead you to hundreds of thousands, if not millions, in extra gains just by increasing your returns by 1 or 2% a year. It's a no-brainer. Join the other 6,000 people who've done it. They've loved it. It's been great.
If you want to trade 3M at a quicker pace, you can join Trader Mo and the BidNast Nation, that elite trading tier of our subscribers. And Mo, what are people? Oh, look at that. Look at that over there. Look at this
Yeah,
chart.
this one's interesting. So I actually just sent out, I added this to my watch list in the Discord because, so what we're seeing right now, I like where this stochastic is going. There's no doubt. But I'm going back to 2019. There's a resistance point here, here, here. With the exception of this little blip, we're right back at that resistance point. And if I pull up the other chart, which I'm going to do real quick, you're going to see that we're having a very difficult time getting through 4 of these major moving averages. These lines are, the blue one is 100, 200, 50, and 25-day moving average. So what's it going to need to get through those? It's going to need volume. That's absolutely true. So, but right now, let's zoom in here, see what we can do with it today. It's absolutely on my watch list. I'm waiting for this thing to move into the sweet spot, get some volume, and start making this climb. And all I want to do is get up to just over $200 a share. That's really, I don't necessarily think that it's going to break out to all-time highs and go crazy, but I do think that there is definitely some room to run here over the next couple of weeks. You just got to be patient with it. So if this interests you, this kind of pattern recognition interests you, join the BidNast Nation, get all my training series videos, learn from me, and you will do very well if you follow the rules.
So remember, go to the link below at everythingmoney.com or join Patreon. You can sign up very quickly. Everythingmoney.com, the benefit is you don't get double charged in the first month and you don't pay sales tax yet because we aren't required to do it quite yet. One thing though, look at what Mo just did. Had nothing to do with the fundamentals of the company.
Zero.
So if these fundamentals don't jive with you, but you like the charts, it's a great way to invest in anything just based on the price movement and all that stuff.
In the end, you can watch more of our videos and learn from us. We are here for you. You can get rid of that financial planner who's charging you fees. You can use our software to gain control of your investments for the next decades to come. We appreciate your support. Fondle the thumbs up and watch more of our videos. They're coming up right now. We'll see you in the next one.